The futures market is very likely the best market for you to be a trader in. In the synthetics market, which means the CFD market, there's a lot of manipulation. There's manipulated markets, manipulated brokers, fake brokers, there's everything. And all of these things hinder you as a trader. But the futures market is centralized, it's regulated, and is volatile. This gives us great conditions to trade, become a profitable trader, and become a funded trader. Just last year, I've been able to make over 90% trading futures, and this was on a personal account on a regulated broker. And so today I want to give you the video that I would have loved to have at first by introducing you to the futures market. So without any further ado, let's dive right in. So this is going to be a full guide to futures trading. So let's talk about what are futures first. In a complicated way, futures are a legal agreement to buy or sell a particular commodity, asset, or security at a predetermined price at a specified time in the future. There's a reason why I have this in a complicated way. This is what futures are, because we'll know that this is going to be way more simple, believe me. The futures market are the underlying asset in any other CFD market you see, which means that if you are not trading a futures market, you are trading something that is a mirror of the futures market. For example, for the price of euro-dollar CFD is derived from the 6E contract, which is the euro futures contract, or pound dollar, which is 6B, or US 100 from NQ, or S&P 500 from ES. So again, understand that all of these markets, the S&P 500, the US 100 that you see on your Forex broker, are a mirror of the price action that is really happening in ES. With futures, you own the underlying asset. With CFDs, you do not. Now, what are futures? Again, you have futures for everything. Right here, we have currency futures. You have euro, Australian dollar, Canadian, British pound, everything. It goes anything you might think of, there's very likely futures of. So for example, you have futures for crypto, you have futures for cotton, coffee, cocoa. Let's talk about gold, copper, silver, like anything you might think about that is tradable, there's futures for. We have soybeans. I remember that I've traded wheat in my first years of trading, and I actually had a profitable trade of plus 2%. And I did not know that I was actually trading something that I had a futures contract of. So it was very interesting to see that I found out that it's all just a mirror of all of these futures markets. Now, why do professional traders trade futures? And maybe this is what attracted you to watching this video. And the reason why futures is so amazing in my mind is that futures is a highly regulated market. It's also centralized. There's no price discrepancy between brokers. What you see, I see. And what that means is, again, I'm going to read through all of this, then I'll explain. Traders are able to access all of the orders executed and pending in the market because everyone trades the same market. This allows traders to trade with confidence that the broker cannot manipulate price delivery. This all is not the case with any sort of CFD market. So one of the things that is extremely important for you to understand is that if you are trading the real futures contract, then you are going to trade on the CME. There's no other way around it. That's the regulatory body behind it. Therefore, if you are in the underside of the world trading NQ and I am on this side of the world trading NQ, we will see the exact same price because we're looking at the exact same chart and we're looking at the exact same orders. So because we're all trading the same, you can see all of the orders that are placed on that specific provider, which in this case is CME. This allows for a lot of transparency, something that you do not have with these Forex brokers that are synthetics, which means the price is derived from them. They can manipulate price all they want. And that's something that has been a big issue with the CFD brokers. So it doesn't matter if you are using Tradovate, doesn't matter if you're using TradeStation, these are all brokers. You're going to be seeing the same price and you will be able to access the orders on every single broker because all of the orders are going to be in the books of the CME. And the reason why is because if the brokers do anything shady, they're basically trying to manipulate a highly regulated market and they will face a lot of scrutiny and therefore they would never do it. different contracts. The E-mini is the fraction of the standard contract, and the micro is 1/10 of the size of the normal contract of the E-mini. The micro E-mini was introduced only in 2019 for NQ and ES because it was introduced in gold already back in 2010. And it was introduced because the E-mini contracts were very expensive for a large number of traders. They required more leverage and more capital because they had to do this discrepancy, because for a lot of beginners, they can't just put one mini contract on NASDAQ where every dollar that the NASDAQ moves, your P&L moves $20. That would be very, very extreme for a lot of traders, because if the NASDAQ would move down $100 and they are in a $100 drawdown, they would actually be, with one mini contract, they would be in $2,000 worth of drawdown. And that is a lot. It requires a lot of leverage and it requires a lot of capital. And that's why they introduced the micro contract to allow smaller traders to also trade in these markets. And I have all the specifications very, very soon here. From now on, let's just use NQ and ES as examples. Is the best way. Don't think about gold, don't think about wheat, don't think about corn, don't think about anything, okay? NQ and ES, it's also the ones that we are going to be trading. So different contracts. So we have NQ and MNQ. All of these are on the CME. The contract size is either $20 on the E-mini or $2 on the MNQ. So again, if NASDAQ moves $1, the micro contract P&L would move $2, while on the E-mini, if NASDAQ moves $1, your P&L would move $20. The tick size is basically the lowest amount of change that is going to happen in the market, and it's going to be 0.25. So one of the things that you will notice is that NQ always moves in 0.25 increments, and also on the S&P 500 is 0.25. So for example, while on Euro US dollar, for example, is by points, which means it always may move 1 point, with NQ and ES, it's 0.25. It's almost as if Euro dollar would be moving 25 points. And here you can see exactly why they introduced micro. So for you to be able to trade one mini contract, your initial margins would be $11,000. That means that for you to be able to trade one mini contract, you would need to have at least $11,000. While for the micro, it's $1,100, right? So it's 1/10 of the mini contract. And for ES, it's $12,000 or $1,200. So again, this is basically showing you that if you want to trade, you need to at least deposit $1,200 onto a broker just to be able to trade one micro contract, right? Not financial advice, of course. Now, contract months, March, June, September, December. We'll see exactly why after. Expiration is on the third Friday of the contract of the month. So we'll leave this a little bit for later. And now you're going to see one of the big differences between the E-mini and the micro, and that is mainly liquidity, because the liquidity on the E-mini is very high, while on the micro is usually high. It's still great, but it's just that for larger positions, you are going to be better off on the E-mini. So remember when I said, in a complicated way, futures are a legal agreement to buy or sell a particular commodity, asset, or security at a predetermined price at a specified time in the future. Futures contracts have an expiration, and that's why you have different contracts. On NQ, you have NQH, which is for March, NQM, which is for June, you have NQU, which is for September, and you have NQZ, which is for December. All of them expire on the third Friday of the expiration month. And the reason why you want to trade these specific markets is that you want to ensure the highest liquidity for your trades. Therefore, if we haven't reached the third Friday of March, you should still be trading NQH. And I'll show you exactly where you can find this still in this video. Now, expiration dates might sound a little bit tricky. It's like, okay, what happens if I hold it past expiration? And the reality is nothing happens, right? Your position gets realized and you get paid the money that you were profiting, right? That's what we call the settlement. You get settled in cash, which means the contract expires. If you're in profit, you realize that profit. If you are in a loss, you realize that loss, right? Because the contract expires and everyone gets settled in cash. Now, how do we find the contract that we are trading? Well, you can go to Google and look up futures contract for NASDAQ, for example. You can change this for any sort of futures market that you want to trade. Then you go onto the first link. Usually it's the first link. Then you have the code right here, which is the current contract that that we are trading. And it also tells you the contract unit, which means what we've talked about before. So that's why we have contract months, the expiration, last trade date, so on and so forth. Now, by understanding the contract unit, it's going to be very, very important. This contract size is going to be very important because now we are going to go into position sizing for futures, because it's not like in FX where you are trading lots and you can trade 1.01 lots or 1.23 lots or even 4.53. It's not the same because we're trading in contracts, and those contracts have a fixed value, and you cannot trade fractional contracts. So the equation for this is going to be number of contracts equals amount you want to risk in dollars divided by the stop loss size in dollars divided by the contract value, right? So if we have an example, I want to risk $500 on a trade with a $20 stop loss on NQ. So the number of contracts is going to be $500 divided by 20 divided by 20. Right? So this is going to give us 1.25 NQ in mini contracts. But guess what? There are no fractional contracts. So we use micros. So we would change this into amount you want to risk, 500, stop loss size 20, and contract value would actually go down to 2. And then you have 1.25 times 10, or you can, those are the two ways, and you would trade 12 micro contracts. This is up to you if you want to round down or round up. I personally always prefer to round down because of commissions. Now, the reason why I'm telling you this, there are platforms that do this for you. TradingView calculates the contract size automatically, but it's important for you to know how to calculate it. Position sizing is the most important concept for long-term profitability. And I recommend you watching this a few more times and always check the value of the contract that you want to trade. And the reason why I'm mentioning position sizing right here and the fact that it's a little bit different is that you don't want to get caught in a trade where all of a sudden you intended to lose $200 and you're losing $1,000. That's the last thing that I want to happen to you. But just understand there are some platforms that don't do that for you and that can really, really hurt you. So that's why knowing this equation is very, very important. Now, in terms of brokers to use, there are many great and all of them are basically regulated. It's a futures market. It has to be regulated. Some examples are of the one that I use is Interactive Brokers, but you have AMP Futures, TradeStation, Interactive Brokers, Thinkorswim. There are multiple ones. If you do any sort of due diligence, you will find some that are good. So personally, I trade with Interactive Brokers. That's where I've been able to make over 90% last year. I'm trading a lot of futures right now, and I've gotten a lot of students funded in futures prop firms. Now, if you want to know what strategy to use with futures trading, it's going to be right now on the screen. And if you want to join Funded Trading Blueprint, we've introduced futures, and a lot of students have had a lot of success, gotten funded, gotten payouts, and simply have changed their life because of futures trading. So